Greetings, everyone. It's David Darst here to give you a recap of the second quarter of 2025. It was an amazing quarter. April, as you know, many asset prices went down significantly, and then a quick recovery starting around the end of the first week in April. Right now, we basically have inflation is low and continuing to fall, but slowly. The interest rates, we expect gradual cuts by the central bank of the United States and certain other central banks. In the growth cycle, it's still positive, but it is decelerating, and the same thing for the profits cycle. And that puts us into the market cycle of somewhat degree of resilience with some degree of recession risk. Until the fiscal and monetary policy align and volatility, we expect it to persist until this tariff and trade, the full impact of these policies, not to mention the fiscal spending and taxation policies of the U.S. administration. The second quarter of 2025, the S&P 500 was up 10.6%. Year to date, it's up 5.5%. NASDAQ is also up 5.5% year to date. It was up 17.7% in the second quarter. Russell 2000 was up 8%. It's still lagging. It's down 2.3% year to date. Gold was up 5.5%, and gold, as you know, has been the big winner this year. It's up 25.3%, and oil in the second quarter was down 8.9%, down 9.2% for the year to date. Our base case scenario, the economy is decelerating to less than 2% growth, probably not a recession. At least that's not in our forecast. Inflation basically remains a risk from tariffs. The Fed is proceeding cautiously. They continue to do so despite much of the rhetoric that's been leveled against the Fed. Equities can rise moderately from these prices with basically as long as the GDP growth and the profit growth, it's slowing in the second quarter. We're getting the earnings announcement cycle is coming now. And the fiscal and legislative elements, I would not want to overlook those. We have uneven growth around the world, faster perhaps in the United States. For 2025, 1.8%. Is expected. The Europe 0.8%, Japan 0.6%, United Kingdom 1.1%, China 4%. This is for 2025 now. Saudi Arabia 3%, United Arab Emirates 4.0%, and Qatar 2.4%. So you see the growth in the region generally exceeding in many of the developed markets outside the region. The equities, we see monetary policy uncertainty as one of the key factors here. The currency, of course, the dollar's been weak. That tends to be stimulative for exports and for the translation of foreign earnings back into the U.S. dollar since they're worth more. Immigration, there's another issue. Downward effect on the economy, a neutral effect on inflation. Energy, neutral effect on the economy and downward effect on inflation. In tax cuts, the tax cuts would be upward on inflation and upward force on the economy. That would be stimulative, of course. Fiscal spending cuts. There have been cuts in certain parts of this big budget bill, that tax and spending bill that was just passed by a very narrow margin in the United States. And the fiscal spending cuts would be, we think, neutral. It's not really going to be extra positive nor an extra negative. And finally, deregulation would be positive for economic growth and somewhat helpful in terms of putting downward pressure on inflation. Credit spreads are still tight. And we are recommending credit diversification. Spread it out a little bit here. Real estate, property values to us look like they're bottoming. We see some increasing transaction volume in the commercial real estate space. And the cap rates, we think, may have peaked here, capitalization rates. Private equity, many of the rates are compressing. The valuation multiples are reasonable. They've come down somewhat. There's been lethargic, kind of slow deal making. And we're focusing, as you know, on managers who can locate data centers and even electric power and multifamily. Basically, we think that uncorrelated assets have a key role to play here. And positioning-wise, we are neutral in cash. We're neutral in high-yield liquid corporate credit. We're neutral in public equities, private debt, public debt, and real estate equity. We are neutral to slightly overweight in investment-grade bonds, collateralized loan obligation debt, and preferred equity. And then we are overweight in collateralized loan obligation equity, private equity, hedge funds, and, of course, the secondaries. Thank you very much for being with us. We look forward to catching up with you very soon.